Right, good day learners. Another type of question that is often asked in grade 8, 9 and 10 is that of the accounting equation. Now again, if you're not happy with this, I suggest you go back to the web page, to the videos that are under grade 9, in which there's extensive explanation on the accounting equation. But right, the accounting equation is just a summary instead of drawing up all the journals and posting to the ledger. So what they will do is, we know that there's a transaction that takes place and it gets put into a journal. We then have to post it to the ledger, so we need to say what account debit and what account credit. So that's based on your DAX cell of your general ledger. The amount, which most times you will find the amounts don't change, but there are some you have to work out. And then this is based on your assets, owner's equity, and your liabilities. Your basic accounting equation, that assets equals owner's equity plus liabilities. Now, if you remember your ledger accounts, that these three accounts all come into your balance sheet. But there's another section of your ledger, the nominal section, which includes all your expenses and income. Now, expenses and income are brought together in an income statement or statement of comprehensive income to work out a profit. And the profit belongs to the owner. So when we look at owner's equity is the capital, which would increase the owner's equity. He'll have more in it. Secondly, it'll be drawings. If he takes money out, his drawings will decrease his investment in the business. But then it's the profit, and profit is made up of income. So income increases the profit that the owner makes, and expenses will decrease it. If you look at a balance sheet under your owner's equity note, you'll see it's capital plus net profit, and net profit is income minus expenses minus drawings. And so when you're doing the accounting equation, that's probably the most challenging part, is to realize that any of those accounts will affect the owner's equity. And as we're going through it, you need to ask yourself the question, what effect would that have on my owner's equity? Now, because many learners do battle with this section, I'm going to do this one step by step with you. I would suggest you actually try it on your own and then mark your work with me explaining. So the first entry says to you that the owner deposited 120,000 capital into the business's bank account. So we know there's got to be a double entry, and my two entries that are involved obviously is bank and capital. Now, bank is an asset to the business. So an asset, your bank is going up, so you increase an asset on the debit side. Your DAX cell rule, please, coming in here. So bank is the asset, your asset is increasing, and that is why the asset has got a plus, because your asset account is going up. Capital increases on the credit side from the cell. But capital is part of owner's equity, and your owner's equity is going up. And there is nothing under the liabilities. The amount is given to you in this case. If we look at the next entry here, the owner gave his personal vehicle, valued at 240, to the business as part of his capital. Now it's still very similar entry, it's just that now the business is receiving a vehicle. But vehicle is also an asset. So when an asset increases, it debits. So that's why our vehicle is on the debit side. That's the name of the vehicle account. The asset account, that's increasing. And that is why they must be joined. You see that because I've got vehicle there as the asset, my assets must increase. Capital is increasing, so it goes on the credit side, and it's a plus under owner's equity. And again, nothing under liabilities. And I'm not going to talk amounts unless it actually does change. Right, number 7, we purchased trading stock for 50,000 less 5% trade discount. And we made an EFT to pay for the goods. Now remember, an EFT is the modern day method of making payments where you make use of the internet. So here, this time we are paying money. So bank, which is our money account, our asset account, is decreasing. So assets decrease on the credit side, and that's why that asset will decrease. You're going to have less money. But you're buying trading stock. Trading stock is an asset. Trading stock is going up, so it's plus. So while one asset increases, trading stock goes up, bank goes down. So ultimately no change on your assets, but the 47,500, which please take note, is minus the trade discount, historical cost. What price are you paying? Although the goods originally cost 50,000, you were not charged that. One asset's gone up, one asset's gone down. Right, now let's look at the next one, and this is one that often gives problems to learners. We are selling goods for cash. Remember when we looked at our journals, we're selling for cash, so it's going to be your cash receipts journal. There's a sales amount, and very importantly, there's a cost of sales amount. So it would have gone in the cash receipts journal, but first of all, we're selling the goods. The selling price, the 21,000. Because you're selling for cash, your bank, your asset is going up. And the selling price goes to a sales account. Now sales is an income to you, so that's going to mean more profit to the owner. As soon as your income goes up, it means the owner is starting to generate a profit. But with every sales, there has to be a cost of sales entry. And your cost price, first of all, working the markup of 50%, which I'm not going to go through now, but you need to know how to work out that calculation of the cost of sales is 14,000. Now, your cost of sales is an expense, so it's debited. Trading stock is an asset. You're selling stock, so your asset is going down. So that's why you've got to credit trading stock, and your asset's going down. Cost of sales is the expense. It's going to reduce the profit. Now let's look at that. We've put an entry, we increased by 21,000, but we decreased by 14. That's because although we got 21,000 in, we had to buy those goods. It was an original cost of 14. So the profit, the difference between there, is the 7,000. Now this is an entry that lots of people get wrong. It's very common for people wanting to put an entry for bank and trading stock. But they're two totally different concepts. One is the selling price, one is the cost price. So please make a big note to your star that you must remember with every sales, whether cash or on credit, you must have two lines, one for the selling price and one for the cost price. Right, the next couple of entries all affect the petty cash. Now petty cash is an asset. It's your money. It's just actual money like you've got in a purse. Now we're withdrawing 1,000 Rand from the current account, your bank account. So your bank account's going to go down to set up a petty cash. Just like you going to the ATM, taking money out of your bank and putting it into your wallet or into your purse. So the first thing is that there's going to be less money in my bank, so bank is going down. So you're going to credit. So your assets going down. But that money, that 1,000 Rand is going into petty cash. That's still an asset to you. So you've another asset, your petty cash is going up. So you haven't actually lost the money. It's just moved out of the bank into petty cash. Now you're going to pay some amounts here. So first of all, we're paying wages. Then we're paying cash. And please, because it says paid cash, you're paying actual money, is why it's petty cash. And then the next one, it says you bought stationery and you paid from petty cash. Now in all three cases here, your petty cash is going down. Your money's going down. So petty cash must be minused. Your asset is going down, so you're going to credit the petty cash. And in all three cases, your asset's going down. You're spending money. You've got less money. You paid for wages, you paid for fuel, you paid for stationery. These are all examples of expenses. And expenses are all on the debit side. And because they're all expenses, it's going to reduce the profit that the owner got. Every expense means less profit at the end of the day. Now, looking at drawings over here, the owner withdrew cash from petty cash. Now, if he's drawing for his own use, and secondly, he's taking stationery for his own use. So we know that anything involving for his own use, the business entity rule says you've got to keep it separate from the business. It goes to a drawings account. Now, drawings is debited, your Daxel rule. So you're going to have two different drawings. The one is taking petty cash. Now petty cash is money, so your actual asset is going down. Drawings, on the other hand, is decreasing your owner's equity. He's taking money out of the business, so he's got less of an investment in the business. Same as if you drew out of your bank account, you'd have less in the business. The second one is still drawings, but he's taking stationery. Now we need to watch this. Drawings decreases owner's equity because he's taking it out. Right, but now stationery. When we bought the stationery up here, we said we bought this stationery for the business and it was going to be an expense. So because stationery was on the debit side and it was treated as an expense for the business, we would have minused it from the profit. But now this is not for the business. This is for private use. So we've got to cancel. And because we originally minus, we'll now have to plus. Business entity rule. So while the drawings is decreasing the owner's equity, there's going to be no profit. That item's not affecting the profit because it's not a business expense. Now, that is where it can get a bit tricky. So just spend a bit of time there, relating back. Stationery, we bought it. We said we're buying it for an expense. In other words, we bought it to use it. So we would mean less profit. We want to cancel that. And you know from maths that if you want to cancel, you plus. But drawings, he's still taking it out of the business, and so his owner's equity will go down. Now the next entry over here, petty cash balance was restored. Now you will have known that when you did petty cash, you spoke about the impressed amount. Whatever has been spent here, the 150, the 560, whatever we spend, we've now got to restore. We've got to make up. We've got to get enough money back to compensate for all the money we've spent. So from the point of view of the amount, you had to go and count up all these amounts that went out of the petty cash here, and a total of 970 went out the bank. That's all of these amounts here that you've paid. So you've got to get back 970. That's restoring it. And then the entry is the same as we did before, taking money out of the bank, going into petty cash. So while your petty cash is going up, your bank account is going down. Right now, and I want to look at the loan entries over here. So back to the 20th, which I left out. We borrowed 70,000 from Den Bank at an interest rate of 12%. Today, we're borrowing the money. There's no interest. That's just the rate. So we're not going to make an entry for that. So we're receiving 70,000. So on the 20th, our asset is going up. But we're borrowing this. We've got to pay it back. So loan becomes a liability. And so we've now got a liability. So it's a plus. Then on the 26th, they tell you that Den Bank capitalized the interest. So the first thing is now we're going to have to go back and work out 12% of 70,000. But that is for a year. It's per annum. You have to divide by 12 to get just 1 month's interest, which they ask. So that's the first thing we have to calculate the amount. Now, capitalizing interest means they're adding the interest onto the loan. So we're going to have an entry for interest on loan. Interest on loan is an expense. It's a cost to you. When you borrow money, you've got a cost. So that's why we debit interest on loan. Because it's an expense, it's going to mean less profit. They're capitalizing the loan. They're adding it onto the loan. So your loan is actually increasing. And so your liability has gone up. Right. And then lastly, we now paid off. We paid the interest on the loan plus 1,000. So we're paying, cash payments journal. Our bank is going down. So we credit our bank and our assets going down because we're paying it. And what are we paying? We're paying the loan. And so our liability is actually going down. We had a liability of 70. We added on another 700, so the loan increased. And now we're paying off 1,700. So we actually paid off the interest, the 700. And we're paying an extra 1,000 off the loan. So the loan is going down. The challenge with these type of exercises is to actually break it down. Take it step by step. When you read a line, you often think, well, I don't know what they're asking. But if you take it and say, right, read the entry. What are the two accounts that are affected? Which is debit, which is credit? And some of them are very obvious and easy. Like bank, you often can just slot it in. And then the other one automatically comes in. Once you've got this debit over here, then you can say, right, what type of account was it? So what effect? The credit, what type of account it is? What effect? And because we've only got two accounts, there's a debit and a credit, there can only be two pluses or minuses here. Sometimes they're both plus, sometimes they're both minuses, and sometimes they're a plus and minus. Now, I'm not going to go into it now, but that is because you've got an accounting equation here. You've got an equal sign. So the left of the equal sign must always equal the right. So if you're going to add on to the left, you must add on to the right. If you're going to minus on the left, you'll have to minus on the right. Your equation must be in balance. The totals must be equal. But if both of them happen to be on the assets, or as we saw over here, both of them were owner's equity, then one will increase, one will decrease, so that your equation is still in balance. Now learners, this particular exercise has got extensive notes to help you. It's telling you all the details under here. You can see all these numbers here, particularly where there are amounts. They've worked through it. So please use this as well as my lesson over here to go over and make sure you really understand this before you go on into more of these accounting equation exercises.